on board. Taimur Baig, MD and Chief Economist at DBS Bank, joining in on the show right now. Taimur, hi, morning. Heightened anticipation now, looking at the US CPI, that it's going to be a rate cut finally from the Fed this September. What are you building up?
I think that there are still things to worry about with respect to the inflation dynamic. When we look at what's happening with prices that are tariff relevant, they are going up. They can be considered as one-offs, and the Fed could sort of conceivably say that we're going to look past it and go ahead and think about other things than inflation, namely the weakness in the labor market, which is palpable. So based around that, we have been always in the camp that the room for 225 basis points rate cut in late third quarter and early fourth quarter were available, and I think we're heading in that direction. But mind you, this issue of headline inflation getting some upward push from tariffs is not going to go away. We could be sitting in the first quarter of 2026 and second quarter of 2026 seeing lingering impact of these tariffs on headline inflation numbers and as well as probably on the core inflation numbers. That would make the Fed's job in 2026, just when Powell is stepping down, just when Trump is becoming even more desperate about rate cuts, it's going to become very, very complex for the Fed. Regardless of who is there, no matter how much of a loyalist he is to Trump, from a headline perspective, inflation going well past 3% in the first half of 2026 would be problematic. But that's an issue for another day. Today, for the next 3-4 months, I think there is some runway for the Fed to cut rates.
Okay, so looking optimistic and headed in the direction of a Fed rate cut. Taimur, hi, morning. Just want to discuss some comments made by Donald Trump late last evening, wherein he says that the tariff impact has not, in fact, the tariff situation has not impacted the inflation. But do you believe now is still too soon to be talking about this and we should be waiting a little bit longer because before the tariffs start impacting? Or do you think he's actually right when he says that there is absolutely no impact of tariffs on the CPI?
Right. I think we have enough data right now to get a good sense of how this is playing out. There's a three-pronged strategy as far as a company is concerned facing higher tariffs. Strategy number one is to go to the suppliers and say, can you take a discount, at least for a while? We have a long-standing relationship. Please take a discount because I can't deal with passing all these tariffs through. I'll get in trouble with Trump. I'll lose market share and so on. And some of the suppliers, particularly in China, but elsewhere as well, are agreeing to that, some discount for the time being. Second is you take it on your balance sheet, and we've seen this guidance coming from a whole bunch of U.S. corporations who are saying that they are paying a lot of tariffs and that is hurting their bottom line to some extent. Third is passing it through. It will all end up in the third eventually. But right now what we're seeing is more of the first and the second, squeezing the suppliers to some extent, taking on some of the hit on the balance sheet, and ultimately, it will all get passed on to the consumers. It'll be a protracted process. It will not be the greatest outcome for the U.S. economy per se. It will erode competitiveness. It will also manifest in a one-off increase in the price level, but it will happen in a protracted manner. It is not something that one can declare victory or loss right now. We'll have to see play out over the next 6 to 12 months.
Taimur, but I guess a lot would depend on whether the Fed moves on softening, right? Because I bet a lot of money is also sitting on the sidelines waiting for it to be deployed back into U.S. should there be a cut.
I think that in terms of U.S. Treasury market outlook, the outlook is not as contingent on a likely rate cut as one would think. I think that's a much bigger function with respect to U.S. fiscal position, with respect to the overall debt management of U.S. Treasury, and the various policy noises we're hearing about whether the U.S. wants to be more confrontational with the rest of the world in terms of holding U.S. Treasuries, whether it's recently passed legislation, the Genius Act, what it means for Treasury demand. I think all of those things play a big role in determining global investors' appetite for U.S. Treasuries, not just the short end. Because if we just keep all of those things aside and just think about the short end rate cuts to some extent, reflecting political pressure from Trump, to some extent being oblivious of the inflation situation that might get complicated down the road, then the curves will probably steepen, not necessarily flatten in response to a rate cut. So I think the data flow with respect to jobs market, with respect to activity are important. And those things are actually showing some degree of weakness. That might lead to the market expecting a series of rate cuts. They may be disappointed with that. We may get a couple, and after that, life might get very complicated.
All right. Hi, Taimur. Morning. This is Shrishti also joining in. But with respect to the U.S. market, the record run continues. How much of it do you believe is on the back of the fundamentals, and how much of this is on the back of sentiments rather? And along with that, the Asian markets too, they are also holding up for now, and select markets like Japan, they are actually seeing a good rebound. What's definitely making this rally continue? What's your take on that?
So let's divide the story in two parts. One is the U.S. and one is the rest of the world, because in my view, there are two different stories. In the U.S., clearly the AI and Gen AI related spending spree, nothing like this has been seen in history, right? The kind of money the large tech companies are spending, and that is creating a huge amount of demand for talent, for goods, for services in the tech sector. And that is just absolutely spectacular. And it's a very lopsided stock market boom. You take the top 7, top 8 companies aside, the rest are actually doing pretty ordinary. And that's where the connection between the rest of the market and the weakness in the jobs front and weakness in activity front come in. But for the top 7, top 8 companies, it's a golden age. Investors cannot give them enough money. They cannot reward them with any higher valuation than what is justified. Sentiment is extremely strong. Now, for the rest of the world, I think what we're seeing is some degree of home bias displayed by investors, not at the expense of the U.S. People are not divesting from the U.S. It's not a de-dollarization story, but it is a story where European investors, Japanese investors, Chinese investors, Southeast Asian investors are finding it in their own interest to have more capital in their own markets. The cross-currency basis has moved in that direction. The yields are not bad at the long end of the spectrum. Stock markets valuation are very attractive compared to the U.S. I think all of those things are bringing both domestic investors back to their markets to some extent, and U.S. money managers. I'm seeing significant amount of interest in non-U.S. jurisdictions as well. Not a de-dollarization story, but a story of where the wider spectrum of the market is becoming more appealing.
Okay, Taimur, thanks for your views this morning, and thanks so much for your time. Appreciate you joining us this morning. Thanks so much. Let's move away from that. And while we are talking about US CPI, we also have the same metric get reported back home last evening, wherein